Good morning, YouTube. This morning we're going to take a quick look at three things. The M2 money supply, the Fed rate over time, and the stock market index, and kind of compare what's going on in the three so you have an update of what's actually going on. Most people get their news from the news, and the news tends to hype things and not kind of give a steady flow of information. And so let's get right into this. We'll start with the M2 money supply. As I said before, 21.7 trillion is the total money supply, and it started tapering down in August as we raised interest rates, and now on 21.2, and now it's back to 21.27, so just barely higher than it was. This has to come down in order to taper off inflation, and as you see, it didn't start to come down until March 2022, which is way too late. You look at the stock market index. Stock market index primarily works based on anticipation, and if you look, we'll do a 5-year chart. Go back to March 2022. Money starts being disappeared. It starts going down as the money goes away. Now it has an anticipation here that maybe things won't get as bad as it thought it would. Maybe interest rates won't raise for as long, and so it comes back some. But I think at some point in here, they're going to discover interest rates are going to be up and go up higher than they are, and this will come back down to kind of a more anticipated level like in October. And then thirdly, we can look at the Fed interest rates. And one of the things you want to do that you can understand things better than the government does and the news does is instead of looking at the short-term horizon, look at the long-term horizon. And so if you look here, at 5.25% interest rate back 2008. This is what popped the housing bubble, and when it popped in 2007 and 8, they had to crash interest rates down, to kind of bring us out of that. Here you had interest rates start going up, get to a level, and COVID occurred. They brought it back down to pull the stock market out of that. Back here in the 80s, inflation finally got handled and it came back down. But these rates went all the way up to, 18% with no event. Right now we're at 4.57. What you'll start seeing is issues with commercial properties, especially. Commercial properties are on variable rate loans always. And you have a 1 year, you have a variable total, or a 5-year, or a 7-year. Most of the time, they're going to do the lowest interest rate, thinking that they'll get the place built, or they'll turn it around and flip it. And when that doesn't happen, your interest changes from 4% like it was before to maybe 7%. It's doubled so far, and so you're going to see some effects from that. You already saw just recently. A default by Blackstone in a different country of $525 million in commercial debt, and that is because they're trying to renegotiate their rates, which I don't know if they're going to renegotiate or how that works, but this rate, I don't see it really going up or coming back down quickly, because if you see the trajectory here, it hasn't really slowed much. So I think that they've already said what they're going to do, and I think inflation is, let's say, 7%, and what they're trying to do is get the interest rate, the base rate, to the inflation rate. Now, I don't think that's actually necessary. I think they only have to get the interest rate to inflation rate. So let's say the commercial and home mortgage interest rate is 7%, and inflation is 7%. I think that'll start tipping the balance and pushing inflation down, but I think they're targeting the base rate, and right now we're at 4.57. Inflation's at 7, so they have a 2.5 point variance there still to go. Now, let's say they get to 5.5%, and enough bad things have happened, the inflation drops down to 5. Then I think they'll just steady out at that and maybe taper it as inflation comes down. But if it stays at 7, I think they'll push it all the way to 7 or above 7 as the base rate, which will put commercial at about 10%, which triples the cost of all commercial property on the balance sheet. And I think you'll see some definite downturns and bankruptcies as that occurs, just like you did in 2008. Now, 2008, the difference between now and 2008 is in 2008 there was a whole bunch of subprime residential mortgages, and people were borrowing things at 3-year, 2-year, 5-year, and that stopped a lot. Most people use fixed rates because they learned, but on the commercial side, that didn't change. You have companies with strong balance sheets, and they're able to do, a 5-year fixed. The bank doesn't do 30-year fixed lending for commercial in most cases. And so because of that, what you'll see on the commercial side is a similar issues that you saw in 2008, because they're going to have triple the investment costs in those properties. And I think you'll see properties that are unfinished. I think you'll see properties that they walk away from. I think you'll see banks, take those properties on their books at some point and have to try to turn around commercial properties. Not quite as easy as residential's, but we'll see how that plays out. What I'm looking for right now is, how to get ready for this situation. At 10% interest rate, that raises a lot of cost on the real estate side. How long is that going to be? Do you work on your cash flow and your interest, paying things down to get ready, or do you work on your cash buffer to kind of roll through that, couple year period of pain, and then bring it back to regular interest rates at some point? So I wanted to give you a little perspective on 3 things today: the Fed rate and what's going on with that, the stock market. As you see, it hasn't reacted as much as it might have, otherwise, and then the money supply, which right now just ticked up just a little bit this month, but has come down about $500 billion. And so I hope that helps you to understand what's going on in the economy. Right now, not terribly bad, but I would say in the next 12 months, you'll see a lot of events be occurring on the news, and they'll be shocked that they're occurring, but they're occurring as a natural result of what the Fed is doing as far as raising interest rates. The Fed knows that these bankruptcies and these problems in commercial lending will occur, and I don't think they're really concerned about it yet, because they're more concerned about the way inflation is stealing money from residents, and the commercial bankruptcies will most likely be blamed on the commercial companies and the lenders if they have problems and what they've done, even though it's really not normal to anticipate that the rate is going to go from 0 to 5% in a year and a half. And so that really isn't something that banks and corporate lending things expect. And that's really the fault of the Fed, but it won't get blamed on the Fed when corporations, like Blackstone, defaults on $525 million in debt. That's not being blamed on the Fed. That's being blamed on Blackstone. And so the Fed knows that, and that's why they're not worried about that. So I hope this has been valuable for you, and you have a great day, and try to make some wise decisions today. Goodbye.